stop scrolling and look at your 401k statement right now. Because on January 1st, 2026, the IRS isn't just going to adjust your taxes. They are executing a literal targeted rug pull on your retirement. We are talking about the biggest tax cliff in American history. And while the jackasses in Washington are busy spending your future to fund a globalist agenda, the 1% have already quietly moved their capital into 3 specific safe havens that you have probably never even heard of. Most of you saw my last video on the retirement tax trap, and your comments were loud and clear. You are completely sick of the simplistic, low-effort garbage the mainstream media is feeding you. You are worried about the Social Security squeeze, the national consumption tax rumors, and whether your American dream is being turned into a living nightmare. Today, I am not giving you a maybe. I am giving you the definitive 90-day exit plan. I am revealing the exact legal loopholes and the Roth Conversion Ladder that the elites use to become completely tax invisible before the TCJA sunset hits. By the end of this deep dive, you will know exactly how to audit your own estate. We are going to break down the fair tax fallacy, how to hedge against Biden's 2026 bracket jumps, and why the Trump-era tax cuts expiring is the ultimate hidden tax on the middle class. If you are tired of being the government's silent partner, and you are finally ready to take your hands off the retirement treadmill and actually keep what you earned, pay attention. This is the only survival guide you need to beat the 2026 tax extinction. Let's look at the data. Let's get real. Most financial gurus tell you to just wait and see. That is dangerous advice. Here is the math the IRS doesn't want you to do. When the Tax Cuts and Jobs Act sunsets on December 31st, 2025, the 12% bracket jumps to 15%. The 22% jumps to 25%. On a $100,000 retirement distribution, that is a $3,000 to $5,000 lazy tax you are paying just for doing nothing. That's not just inflation. That's a government-mandated heist of your purchasing power. So, how do the big boys handle this? They use the Roth Conversion Ladder. Think of this as a tax fire sale. Right now, taxes are at a historic low. You have a narrow window, a 24-month gap, to move your pre-tax 401k or traditional IRA money into a tax-free Roth bucket. Why now? Because you'd rather pay 22% today than 25% or 28% in 2026. By climbing the ladder and converting small chunks of your wealth every 90 days, you are effectively locking in your tax rate at a discount. You are firing the IRS as your business partner for the rest of your life. It's the ultimate fair tax strategy you can implement yourself without waiting for a bill to pass in DC. I see your comments about the national sales tax and the globalist shift toward consumption-based models. Here is the insider secret. If the U.S. moves to a consumption tax, they will still want to tax your income on the way out. By moving to a Roth now, you are building a financial fortress. Even if they shift the goalposts later, having your money in a post-tax vehicle gives you the highest level of capital protection available under current U.S. code. But here is the catch. If you do this conversion wrong, the IRS will hit you with a 5-year rule penalty that could lock up your cash when you need it most. In just a second, I'm going to show you the day 1 to day 90 audit checklist to avoid that penalty. But first, we need to talk about the Social Security rug pull that is happening simultaneously with this tax cliff. Now, let's pull back the curtain on the Social Security rug pull. While the mainstream media screams about a 2.8% cost of living adjustment, they are completely silent about the dual trap waiting for seniors. First, Medicare Part B premiums just surged by nearly 10%. That means before your increased check even hits your bank account, Washington is already clawing back a massive chunk of your money. But it gets much worse. The true trap is what the IRS calls provisional income. If you pull money out of a traditional 401k or IRA to survive, that distribution counts toward your provisional total. The moment your combined income crosses a pathetic $25,000 for individuals, or $32,000 for married couples, the IRS steps in and taxes up to 85% of your Social Security benefits. Think about that. You are being double taxed on the very safety net you paid into your entire working life. This is why a traditional retirement strategy is financial suicide under the current system. This brings us directly to the 5-year rule disaster. If you execute your Roth conversion incorrectly, you face immediate penalties. The IRS mandates that converted funds must sit in the account for 5 consecutive tax years before you can touch the earnings penalty-free, regardless of your age. If you ignore this timeline, you trigger a devastating 10% early withdrawal penalty. You are locked out of your own capital when you might need it most. To stop this government heist, you must implement the 90-day audit checklist immediately. Step 1. Determine your current exact tax bracket margin. Do not convert a single dollar that pushes you into a higher marginal tier. Step 2. Establish separate, unique Roth accounts for each annual conversion chunk to cleanly track your 5-year holding periods. Step 3. Calculate your modified adjusted gross income precisely to ensure your conversion does not trigger massive premium surcharges. This is how you outmaneuver the system. This is how you protect your estate. Now, most YouTubers are going to tell you to just buy a Roth and pray. But that's 20/20 advice. We are in a 2026 reality. The old 60/40 portfolio is a death trap in a high-inflation, high-tax environment. If you want to survive the 2026 tax extinction, you need to stop acting like a retail investor and start acting like a sovereign saver. You need to move your at-risk capital into the 2026 sovereign cash pivot. Here is the fresh move nobody is telling you. In the U.S., interest on federal treasuries is exempt from state and local taxes. While everyone else is complaining about the IRS rug pull at the federal level, the smart money is using a Treasury Bill ladder to zero out their state tax liability. Think about it. If you live in a high-tax state like California, New York, or Illinois, you are getting hit twice. By shifting your emergency fund or your conservative cash into short-term T-bills, you are effectively giving yourself a 3% to 10% immediate tax refund compared to a standard high-yield savings account or a CD. You aren't just saving. You are tax shielding your liquidity before the 2026 brackets jump. But there is a second part of the sovereign strategy: tactical harvesting. 2024 and 2025 are going to be volatile for the U.S. markets. You shouldn't just hold through the dips. You should be harvesting your losses now to create a tax credit bank. If you sell a losing position and immediately buy a similar, but not identical asset, you can bank those losses to offset up to $3,000 of ordinary income or unlimited capital gains when the 2026 taxes hit. It's like creating a get-out-of-jail-free card for the IRS. You are building a wealth shield that makes you immune to the 2026 bracket jumps. But there is a catch. If you use the sovereign cash strategy but forget about the IRS look-back rule, they can actually come back 3 years later and claw back your gains. In the next 60 seconds, I'm going to show you the clawback protection move that the 1% use to keep their audits at zero. If you miss this, the rest of the strategy doesn't matter. Now let's address the absolute centerpiece of the elite playbook, the final hurdle that stands between you and permanent wealth security. I am talking about the IRS look-back rule, the ultimate trap designed to compromise everything we just built. Most retail investors falsely believe that once a tax year closes, their liability disappears. That is a dangerous, amateur delusion. Under current United States tax code, the IRS operates on a standard 3-year statute of limitations. This means federal auditors have a full 36-month window from the exact date you file your return to retroactively dissect every single transaction, claw back your gains, and slap you with heavy underpayment penalties.